We've got a very busy week coming up as the pace of company news quickens after a bit of a lull in August and the macroeconomic data continues to come thick and fast. Top down, key points of interest will include the latest UK inflation figures on Tuesday the 12th of September and then the Bank of England's response to them. We've got the latest interest rate decision on Thursday the 14th and then a new quarterly bulletin from the old lady of Threadneedle Street on the 15th. In terms of the inflation data, remember that the headline consumer price index rose 2.6% in July, while the retail price index advanced by 3.6%. This chart shows the momentum in the readings since January 2014, with the latest increase primarily the result of a weaker pound and higher oil, although those effects may now be starting to unwind a little. If it does look like inflation has peaked, then the Bank of England may yet again delay that long-awaited first interest rate hike for more than a decade. The Monetary Policy Committee will, however, be back to full strength at 9 members now that Sir David Ramsden has replaced Charlotte Hogg, and it will be interesting to see how the vote breaks down. Remember that last time it was 6-2 against raising rates, and it was 5-3 the time before that. On the company front, we've got 5 FTSE 100 firms scheduled to offer comment on results or host meetings in the coming week. They include Primark and British sugar owner Associated British Foods, set to release a year-end update on Monday the 11th. First quarter results from equipment hire expert Ashtead on the 12th. An analysts meeting at National Grid on the 13th. And interim results from retail bellwether next on Thursday the 14th. For all of the comment that these updates are likely to provoke, the name really capable of causing a fuss for me in the week ahead is grocery giant Morrisons, which is due to publish first half figures on Thursday the 14th of September. Now, Morrisons shares have staged a good recovery since current Chief Executive David Potts replaced Dalton Phillips back in March 2015, as we can see here, and the interim figures will be the next test of the company's turnaround plan. Potts and team got the 2017-18 fiscal year off to a good start with an upbeat trading statement back in May. Morrisons reported like-for-like sales growth of 3% in its retail operations in the first quarter, the 6th consecutive period of growth and one that showed further acceleration for good measure. In addition, Potts stuck to earnings expectations and guidance for the full year, including a target that net debt would fall below £1 billion, down from 1.2 billion last year and 1.7 the year before that. Besides like-for-like growth and net debt, also obviously watch out for the profit numbers. Analysts are now expecting Morrisons to show earnings growth in fiscal 2018 and fiscal 2019 after it finally stopped a long string of profit declines last year. This chart shows the last 10 years pre-tax profits on an underlying basis and the consensus forecast for the next 2 years to January. As a guide, at the first half stage last year, Morrisons made £143 million pre-tax on a stated basis and £157 million before restructuring costs. Finally, take a look at the dividend. For the full year to January 18, analysts are looking for a 13% hike in the total payout to 6.1 pence. So that growth rate's your benchmark for the first half. The interim payment last year was 1.58p. Now those consensus forecasts, which may or may not prove accurate, put Morrisons shares on a forward price earnings ratio of around 20 with a yield of 2.5%, a premium and a discount to the wider UK market respectively. This suggests that the past 12 months share price gains are based on the view that earnings and dividends are going to recover and keep growing, and therefore the PE will drop and the yield will rise, assuming an unchanged share price. Value investors may be also intrigued to see that the company's market cap and net debt combined come to around £7 billion, while tangible fixed assets on the balance sheet come to 7.2. So on an asset basis, the stock may still not be expensive, so long as there are no further write-downs on the balance sheet value of the stores and sites. Thank you for watching, and I look forward to seeing you next time.